We are about a minute away from getting things started. Thank you to those of you who are patiently waiting. 60 more seconds to go. All right, that is the timer. Let me X out of this, go back to the full screen webcam. There we go. We're going to kick it off the way we always kick it off. Happy Sunday. Welcome back to another live stream where we talk about our approach for the upcoming week in the stock market combined with a recap of what we did last week. We had a really successful week last week. Excited to recap what we did, talk about what we got coming up because there should be a pretty volatile week in the market coming up. So we definitely want to be prepared for that, talk about our approach, and just some tickers and events that we have in the back of our minds as we head into the upcoming week. So without further ado, in the early Sunday stream, so I'm sure some of you guys are going to be watching this recorded because I can't compete with the Super Bowl, nor do I want to, and I kind of want to watch the Super Bowl. So that's why we're going live at noon. But really successful week for us objectively, right? We took home $1,051, and we did it in a week where the S&P 500 dropped 1.05% and NASDAQ dropped 2.41%, which in the context of our ultimate goal here, we outperformed the S&P 500 by 1.63% and outperformed NASDAQ by 3%, which is significant, right? That's progress to getting us to our goal, which is outperformance in the market. Jules, morning. Thanks for tuning in and welcome to the stream. I'm a big 49ers fan. I feel like some of you guys know, and they got ruined by the Eagles last week in a game that I'm still bitter about, so I really don't care who wins today. But we did it in a variety of ways, getting back to talking about last week, right? We had some short positions, we had some spreads, we had some puts, we got a little bit more, kind of back to what we typically do, right? We typically start with cash secured puts. We like a bullish portfolio because in the long run, typically the market's going to go up in the long run. That's the closest thing you have to a guarantee in the market. But over the past few weeks, our portfolio has really skewed more on the bearish side. And if we scroll over, we could see it here. All these bearish trades that we've been lining up. So why did we do that? The answer is because we had a sneaking suspicion that volatility was going to pick back up pretty soon and that the market was going to dip. If we zoom in a little bit to the 20-day, we finally started to see that play out. And where did that thesis come from? If we went to the 1-year chart, RSI was getting very, very high. Over 70 is considered overbought from an RSI perspective. Excuse me. And that's really only happened once in the past calendar year. It happened in August of 2022, and that's when it went from 430 down to 348. So anytime RSI starts getting this high, especially on the broader index basis, you want to be paying attention, right? And we started to get there. We didn't quite get above 70, so there was definitely a little bit more room that it could have run up. But I think we peaked at around 69 and change here. So if you go back to the 20-day chart, you're going to see we peaked and then started to fall back down, as is typically the case when RSI gets that high. Now, with that in mind, we're back down to 55. This is a much more neutral RSI and one that I'm a little bit happier to start initiating some bullish positions. And that's what we did last week, right? We started with our stack of largely bearish positions. We were short on Peloton, CCL, Spotify, Wynn, Intel, Airbnb. SQQQ is technically a bearish position because the stock that we're selling a cash secured put on is a bearish stock. It's an inverse ETF. XRT, bearish trade. Meta, Ford, JW1 was bullish, but effectively the first 9 to 10 trades that we have on here were bearish trades, and from those, we made $1,700 in profit. Really, the losses came from the bullish side of things, which I'm okay with, right? We had our bearish thesis play out. If we had just left everything that we had started the week with, we would have made a little bit more. We would have made $1,800-ish on the week, which is, I would have liked 1,800 more than I would have liked 1,000. But at the same time, it is smart when the market starts to pull back to start scaling in with some of those more bullish positions to get yourself to a more neutral portfolio. That neutral portfolio is going to have positions that benefit if the market goes down and positions that benefit if the market goes up. Hopefully it doesn't go too far in one direction, and then, the result is something like this where we took home a profit of $1,000. So top to bottom, Peloton was one that we started 2 weeks ago, right? When we had this 15.5, 16.5 call credit spread. And it was a disaster, right? It ran up against us, yet we managed it in such a way we talked about last week, where we took home $145. And then we continued that trade into this week to make another $330. So on Peloton in the last 2 weeks, despite the fact that it's currently higher than where we started playing it at, we've taken home a profit of $475 on that one. So that one has been a really good short position for us. CCL, this is one we played with a credit spread because Royal Caribbean, sympathy type company, reported earnings last week. And that's exactly what happened, right? If you look at CCL, we were worried that it might run up if Royal Caribbean had good earnings. You go to the 5-day chart and you see that there's this big jump from 12-ish to 1262, which is like, oh no, this is super scary because RCL, the ticker that we were worried about, reported good earnings. You see that move, and then CCL pretty much mirrored that move. However, we were still pretty steadfast in our position that this was going to fall back down. Reason being, again, taking a look at that RSI, it was above 70. This thing was running really, really hot. And that's not to say on a long-term basis that this thing is just going to not go back up ever again. But in a more short-term basis, when 1-year RSI starts to get really hot, that's when we like to step in front of it with the short or bearish position. And we finally got that pullback. You want to play that pullback until you get mid to low 60s and it's down to 55. So right now, we got the exhaustion on CCL that we were looking for. It made us $200 of profit, and if you go look at CCL last week, we made we made $100 on it last week. Excuse me. The week before it, we played it as well for a $10 profit. Nothing crazy, but again, this thing was running against us, and in aggregate over a 3-week period, that's $310 on a trade that we started playing down. Let me go back to the 1-month chart. We started playing it back down here-ish. It's still above where we initially started playing it down. Yet thanks to the option premium we've collected along the way and the way that we've managed the position, we have made money on that position on a 3-week basis. And anytime you could have something move against you and you could turn a profit, that's when you're going to really have some nice long-term success. So that's what we set up with that one. Lyft. I'm not looking at the right week here. We're back. Okay. We've got Spotify. This one was super, super frustrating because as of Friday morning at about maybe 8:50 a.m., it looked like it was on its way to max profit. We go look at Spotify, and what you'll notice is this massive green candle, right? Speaking of RSI, this one is unbelievable. It got up to like 84, 85-ish. You typically aren't going to see RSI that high in a stock, ever on a 1-year basis. So we really had a nice thesis to play this thing back down, and I still like the idea of playing it back down from here. However, there was a headline that a certain investor had taken a stake in Spotify, and you see this massive green candle from 119 to 126-ish, which is, quite frankly, just a massive pain in the ass to have that move against us. But really, the position we were in, we sold a 122 strike call for 327. So our weekly break-even price, you can see right here, was 125.37, and that was right around here-ish. Since it kind of spiked up above that and then fell back down closer to 10 a.m., we took that little dip as an opportunity to say, hey, we did think at one point that we were going to have max profit on this trade. It didn't happen. But when you have a trade move against you like this, right? We had a bearish trade and there was a massive green candle against us. Anytime something like that happens, it's okay to accept a loss. What we don't want to have happen is a continuation of this green candle. Something like we saw with CCL, where you see this big pre-market candle and then another big green candle on top of that. That's what we wanted to avoid with Spotify, because that'll happen a lot. And it looked like it was about to happen a little bit getting towards 11 a.m., but it fell back down. But, moral of the story here, if you have the opportunity to take just a small loss, and $93 is a very small loss here, on a position that's moving against you, I think you do it. The last thing that you want to have happen is it continues to move up against you, and something you were banking on for $300 of profit all of a sudden turns into like a $300 loss, and your week looks a lot worse. So we took the known commodity, we got out, we took the smaller loss, and we moved on, right? We've already talked about Peloton and CCL. On a net basis, these 3 trades are $437 of profit. So the last thing that we wanted to have happen was to have Spotify continue that move upwards, maybe push 130, and then all of a sudden on a net basis, these 3 trades are losing money. At the end of the day, the market was red, our account was green. Our goal on Friday is to keep that, keep the green account. Don't do anything too crazy that's going to crush you. It's just bad luck. It happens, right? Theoretically, there's going to be some equally good luck we run into at some point in the future. Definitely haven't had it over the last few weeks, but just stick with those, right? Be smart, take the smart loss, keep moving. You could always make it back. And I think next week we do have Spotify 130 calls, where now if it stays below, right, we were playing below this level. Now if it stays below this level at 130, which is way up here, we're going to make $222. So it's not going to make all of it back, right? We could have made 327 last week, but small loss, make it back next week, right? There's expiry on the options we sell, but there is technically limitless time for us to make money on these individual stocks. So next one is Wynn. This one we found out over the weekend, Friday after hours. They announced that they were going to be announcing earnings this week, this prior week, that is. So this effectively was a trade that we were bearish on, but then turned into an earnings trade. We didn't want that kind of risk, so we got out of it on Monday. And this was a smart thing to do, right? Because look, we lock in a $51 profit. Yes, if there were no earnings, we could have played the earnings, been crazy, maybe gone for like a profit of, come on, type it in. No, I messed up number lock. We could have gone for a profit of 198, made 150 more. But if we look at where Wynn finished on Friday, they had earnings. It ran up a bunch. It finished at 108. So this would have been worth $4. And we did the smart thing, taking a profit of 51, because if we had held on to it, it would have been a loss of $202. That would have been frustrating. So we take the loss, take the known commodity. We don't want to take the earnings risk on, leave it. And then guess what? We come right back to it next week at a higher strike. We were playing it below 104 this past week. This coming week, we're playing it below 111, and boom, right there. That's that 145 that we left on the table last week. We're just waiting another week to get it. And we have a higher level that we can get it at. And again, Wynn, you go back to that 1 year chart on Wynn, RSI, 73.49 is where it's currently sitting at. A very, very large number. It's run up a ton. It's over doubled from the lows back in last July. And if you go on a 3 year basis, this isn't the type of stock that's going to have some crazy short squeeze. I think we'll probably start to see some resistance, maybe at 115-ish. It's kind of in no man's land a little bit here at the 108 level. Maybe lines up with that candle from back in June of 2020. But, moral of the story here, just sit tight, manage the position. We've played Wynn, exclusively bearishly from this green candle, right? It's continued to run against us. Yet despite that, we're profitable on Wynn on the year. Why is that? It's because we're rolling our strikes higher. We're taking credit. We're managing the position the way we should. We're sitting out of volatile events like earnings, which we don't really have a strong thesis on, and then getting back in when it's smart. So that's how we've managed to, still make money on a bearish position despite this moving against us. And that, is really a common theme with a lot of these trades, right? We've gone into bearish trades. They've moved against us, yet we've managed, right? We've managed. If you go to our year-to-date summary, the worst week we've had so far, and what's crazy is the S&P 500 back in January had probably the biggest month it's had since COVID. So the fact that we had bearish positions had the market move against us as badly as it has, in the last 2 to 3 years, and the most damage that we have to show for it is a loss of $265 in a week, I think is a great testament to how flexible some of these positions are. Again, provided we're following the rules that we set forward with ourselves, right? If we're going to sell a call, we want to make sure that it's not a stock that's going to have a crazy short squeeze. If it starts to move against us, we scale in, right? We don't start with that full size position. We scale into it and then keep moving forward, right? If we have a stock moving against us on a Friday and we're uncertain about it, just take the small loss. Live to die another day with these things. And eventually when you get the move you want, it'll be a nice $200-300 profit on the position. You won't even have to think twice about it. Moving further down this list, Intel was a short position that we started, not last Friday's and 2 days ago, but the Friday 9 days ago, and got out before the end of the day there, but it was this week's expiry, so we counted it there. Same thing with Meta, so not a lot to say there. Airbnb, a good example of what we're talking about with Spotify, with Wynn. They've been running up a bunch. Airbnb was also running up a bunch, but then again, what did we finally get? We go to the 1 year basis, we saw that RSI got into the red, and then we finally get a little bit of exhaustion back down as it slipped below 110 a share, and we took home a pretty stress-free $320 right there. So again, up to this point, cumulative profit of like $1,000, and that's just off a few of these positions. And a couple of them have kind of moved against us. XRT, I was a big fan of the way that we played this one. This is a S&P 500 like retail ETF. And we entered right around here. Again, this is a great example of that RSI thesis playing out. It was super, super overbought. This is a retail ETF. It's not going to have some super crazy short interest. We wanted to play it bearishly. So what we did was at like 74-ish, we actually sold these 72 strike calls in the money. They have a little bit more intrinsic value, meaning that we're going to benefit more from the delta of the stock coming back down since we get a little bit more premium by selling in the money, and that's exactly what happened. And this would have expired worthless, but I believe it was Tuesday morning. We had already kind of gotten a move in our favor, and we said, look, let's just leave $49 on the table to lock in 201, especially early in the week. That's a no-brainer. And while you may look back at the end of the week and say, hey, we could have made 49 more bucks there, that's not insignificant if you start adding these up position by position by position. One, there was no guarantee of that. And two, it's a lot easier, knocking positions out of your portfolio earlier in the week where you're taking profit and then not really having to worry about them on the back end, right? Even if the market did start ripping up against us, all of a sudden, even though we had a long list of positions to start the week, you take profit on like a few of them, the list gets much shorter and there's a lot less worry when things do move against you. And again, if they continue to move in your favor, the rest of those positions you have open should theoretically benefit as well, and just keep moving that way. You can't get mad at yourself for taking profits early in the week and leaving money on the table, quote unquote, right? Because there's no such thing as a guarantee max profit, especially when it's only a Monday, Tuesday, or a Wednesday. We've seen some pretty crazy moves in the market, so we're definitely familiar with what it can do to us. Ford was a good one. We sold a strangle and it finished right in the middle of the strangle, $200 a profit. Big fan of that one. JWN, this was one we had the idea that, look, it ran up a little bit. There's a lot of implied volatility. If the market falls down, which we thought it would, maybe this one wouldn't be as affected. And we were correct in the sense that it wasn't as affected by the overall market, but it did fall back down a good bit. I mean, a very good bit. These red candles are huge. We sold a 23.5 strike put, which admittedly is probably a little higher than we should have gone in at. Ideally, we get back in where the initial gap up started at like the 21-ish level. But we went a little bit higher, and as a result, we got burned a little bit. That was one that started to move against us. We said, hey, we could take a 115 loss. We know that in the scheme of the positions that we hold, 115 really isn't that large of a loss, right? If you net that out with Ford, it's an overall gain right there. That's just one position. So we did. We closed that early for a loss, and it ended up being a smart move, right? We sold a 23.5 strike put. This thing finished at 21.65, so this would have been worth about $2. Meaning we would have lost $760 on this position, but we locked in a loss of 115. So again, small, manageable losses. Don't let these things get out of hand. If it starts moving against you terribly, if you have some conviction and can double down, absolutely do that. Typically, the big dips are a great opportunity for you to jump in and do that. However, this one we really didn't. We didn't love the fact that we got in at 23.5. It fell back down to what, like 21.5-ish. We would have liked it more at 21. So it moved against us. We probably were a little impatient with our entry. And if we look to next week, maybe there is something around that 21 level that offers decent premium. And really, there isn't, right? You can get 1% ROR here, but for how much this thing has run up and then fallen back down, right? It went from 21 to 27, 27 to 21.5. Yet, if you're looking like $1 out of the money, you're only getting 1% ROR. And to me, that risk isn't worth it. So we'll probably leave that one on the shelf. EA, this is one that moved against us, but again, we wanted to have some bullish positions just in case the market continued to move upwards, so we benefited somewhat. The fact that these lost some money for us between EA, Google, and Fetch is a little bit kind of collateral damage, understandable, because we just wanted some bullish positions to benefit. But you look at EA, we sold a 114 strike put, we sold it for $1.03. Our break-even price was $112.97. It didn't make money. It lost $91. But what do? We rolled down, we roll out, and we try to roll for a credit. So we rolled down. We rolled from EA 114 to 113. We rolled out, going from the February 10th expiry to February 17th expiry. And we rolled for a credit, meaning we closed the original 114 strike put for a 194 debit. And then we sold the new 113 strike put for a 206 credit. So that's, 12 cents more. And what's that going to do to our break-even price? It's going to take it down 1 because we sold 1 strike lower, and it's going to take it down 12 more cents on top of that because we sold it for a 12-cent credit. So it takes us down to like a 111, like 80-ish break-even price, which if you go to EA, you just got to kind of roll with the punches a little bit. On a 3-year basis, I'm pretty happy with where our break-even sits. go to a more short-term basis. I mean, if we ignore the big earnings drop, because there's not going to be any more earnings, that 111.80-ish basis that we have, it sits right where the stock price is. So even though the stock has continued to drop against us, and this is a decent like 4 to 5% drop on us, we've managed our break-even price. We're now sitting here at a 111.80, and we move along another week. And again, since we've sold a 113 strike put, we now have upside to 113. We could pull $206 of profit this week if it gets back above 113, which if you net that out against the $91 loss, all of a sudden you've got a stock that moved against you, but you've made 115 bucks on it. And again, we also have the capacity to double down into this trade, but since our break-even price currently sits right where the stock price is, there's really no need to, right? What that would look like is doing something like selling a 111 strike put for a $1.15 credit, and then your break-even price would be lowered by another $1.15, which would go down to like 110.65, which is good progress. But again, we always want to remember in the back of our minds that things can get worse. So we don't want to deploy the extra capital, until they do get worse. Anytime your break-even price is remotely around the stock price, you don't need to deploy extra capital. Just keep rolling with the original trade, manage properly each week, trying to roll down and out for a credit with the cash secured put, and then just wait and see where the chips fall. A very similar idea with Google here. However, we did use our double down. So this would be a great example of how we used a double down to manage a break-even price, right? And I think one good way to look at this might be if we duplicate this tab really quickly and just rebuild the Google trade and kind of demonstrate how this thing started out. So if we quickly do this and bear with me, we started this trade at the, when did we enter into this trade? Looks like during last week, and I think it was right after the big dip down. Let's go to Google, and I could probably tell you exactly when we entered into this. So it looks like we entered on February 8th, right around here when it was at like 99 a share. So if we go to Google, we go February 8th. It's our start date, and our end date would probably be this Friday, hopefully. So there we go. And our initial position, let's X all of these out here. We've got Goog there, and again, it started at $99 a share. Goog, if we do Google Finance, bring that price in, is now at 94.86. So it's dropped 4.18% on us in 3 short days since we've entered. So our initial trade was this 98 strike put for 96 cents. So boom, this isn't one-to-one, and I need to use my brain here really quickly. What I need to do is put this position here. 96 cents. We sold one of them. So boom, we were in a position that would have made 96 bucks if Google held above $98 a share. And that's probably going to be helpful to zoom in here kind of after we entered into it. So if it holds, let's remove this line. Max profits here. And again, we sold this for 96 cents. So our initial break-even price is going to be $98, the strike, minus the credit received, 96 cents. So our initial break-even price is 97.04, which is down here. And look, when you enter into something around here-ish, especially on a good stock like Google, this isn't the worst place in the world to be. And let's go to a 5-minute chart so we can see some more detailed candles here. And I totally messed up that zoom in. Let's just try this one more time. Bear with me. Some really good. So 2.8, we entered right around here-ish. Perfect. 2.8, entered here. Okay, extend this to the left. So we entered here. Our break-even price was here. So that's a decent cushion. But again, things happened very, very quickly in the market. On Thursday, even though it opened at 156 and we were looking good on this, it dropped all the way down to 93.86, kind of near the bottom. And as this thing scaled down, right, it broke through our break-even price. So with the stock that's a little bit more stable like Google, this is when we say, hey, if it gets down to 96 and our break-even price is 97, being $1 away from that is pretty manageable. Now, as it continued down and got down to like 95-ish, that's when we said, okay, this is a situation where it's probably smart to step in with an additional position. And if we, have the formula here that calculates what this thing would be worth, we would see that, at 97, we'd be fine. But as it drops down here to like the 95-ish level, what happens? We're losing $204 on the trade. So we said, okay, I think it's time to double down here. And I totally copied and pasted the wrong trade in here. I don't know why I put 217 for these. These expired on 210. So let me quickly edit that. Some really exciting live stream action right here. So we said, let's scale in with this 94 strike put for $1.07. And what do we know about that 94 strike put for $1.07? Is it's a direct reduction to our break-even price. So the next day, February 9th, we would take our 97.04 break-even price and we would subtract this credit that we received on the trade. That's now going to set us up with the 95.97 break-even price, which is all the way down here. If I can draw a line and it'll let me. 95.97, I believe, is what we said. So, I mean, nothing insane, right? But with a stock like Google, moving your break-even price down another percent, especially on like a 2 to 3 day basis, right? Because this is a Thursday. There's only 2 more days left in the week. This is a very effective way to do this. Now, as it continued to drop, yes, the price or our loss on paper would definitely increase. So if we have this same formula here, but adjusted for a 94 strike, negative one of these, we would see at 95, it's okay. And if it went back up to 95.97, all of a sudden, everything's good and well. And these were open positions, so let's highlight these. But as it continued to drop down to like 94 and it got to what, 93.86 at the bottom, 93.86, we're looking at a $225 loss, which at the end of the day is still not that bad, right? With 2 contracts, how do you make back $225? You need about $1.10 a piece, which on a stock like Google is something that could probably be found out of the money next week. And if we take a look at Google next week, you absolutely could have, right? So you could have sold 2 strikes out of the money there and still gotten that cash back. So even though this thing continued to move against us as steeply as it did on Thursday, we were still in a position where the trade was manageable, right? And let's keep in mind, we started this thing at $99 a share. $99 a share. Got the hiccups on stream. So it's had a decent drop, especially on like a 2 or a 3 day basis. And we're really not hurt that bad. And again, if this thing pops back up to 98, all of a sudden we're at a $203 profit. So if it recovers up here, which definitely could have happened, right? We only really talk about the trades that move against us because those are the only ones that really we have to plot and strategize for. But if it moves back to 98, we're good. But at the end of the week, Google finished at 94.86. And on Friday, when it spiked back up here, you'll run into a situation like this a lot on Fridays, where if you've got something that's in the money by a couple bucks and it's late Friday morning, it's not going to have a lot of extrinsic value, meaning it's effectively similar to owning shares. So what we wanted to do there was just roll this one while we could. And if you look, Google finished at what, 94.86. So if we had continued to hold on to this, it would have been worth 314 at close. However, since it was a little higher in the morning, we were in a position where we said, hey, let's just roll this thing now. So we closed it to a 246 debit. And you may say, HT, but like, why would you close that position out? It could keep running up. We didn't just close it. Remember, we rolled it into the following week. So we rolled it into -1, and let me fix the date here again because this is 210. We rolled the 98 strike put to a 96 strike put expiring next week for a 248 credit. So if you look at what we did, we bought to close for a $2.46 debit. Right, we want to roll down and out for a credit. We rolled down from 98 to 96. A $2 roll down is very significant from a strike perspective. And while the credit is very small, it's a 2-cent credit. The difference in what we closed the initial one for and what we sold the new one for, it's very insignificant. However, it does a lot of damage to our break-even price. And the great part about this is that this 94 strike put expired worthless. So while we did use a little bit of the cash that we kept in our back pocket, because we start with 1 and we want to have the capacity to double down to 2, we're now back to 1 contract next week, and the result of these last 2 trades is a loss of 43 bucks. So now if we put our new formula in here, which is going to be 96 the strike minus the stock price, Google as it currently sits is going to be worth, these 96 strike puts, if Google finishes next week at 94.86, are going to be worth 114, and all of a sudden we're making money. Even though it's fallen this far on us in a 3-day time span, as long as it holds this price right here, we're making money overall in the trade. In fact, our break-even price is going to be 91 cents below that. So our break-even price is 94.86 minus 0.91, so 93.95, right? If Google goes down to 93.95, what do we see? I may have calculated this slightly wrong. No, this is 0. This needs to be pasted. We break even, right? So our break-even price started here on Wednesday. It got here on Thursday. And then as a result of rolling on Friday, it's down to 93.95. And that's a great example of how, starting small, doubling down to get from here to here, and then rolling into next week to get from here to here, is a very, very effective way to manage these positions. And if we look at this on a broader scale, yeah, it probably doesn't look as crazy as when we're zoomed in on like that 3-day basis. But let's remember, what we're looking at right here is a month basis. And our trade is only going to last 5 days. So even if we look at it on a 5-day basis, doesn't look crazy, but this is the initial sell-off they had. Google is, I think, a very strongly valued stock, meaning the valuation is good in my opinion. So it's something I'd be happy to own in the 90s. And what have we done? We've set ourselves up in a situation where if we're assigned these shares, we're going to have 100 of them at 93.95. And we did that again on 210. So there you have it, right? And if Google continues to move against us and goes to like 90 or something like that, I mean, that's going to suck. That'll be a very, very large dip. But then what do? We take that cash that we have in our back pocket and we double down again and we scale back in. So we presumably can maybe get another dollar on something. And if we drop this by like $1.15, all of a sudden our break even is 92.8. And then we go from there, so on and so forth, and just kind of chase the thing down. And at the end of the day, Google is not some insane growth tech pre-revenue stock. It's a very solid valuation. And to kind of further that point, if we go to Google stock, what you're going to see is a PE ratio on this of 20.81, which is roughly in line with the S&P 500. You compare that to something like Amazon, where you're going to see a PE ratio. I don't know why they don't have it. Maybe it's because they lost money last time, but it's about 70 to 80-ish on Amazon. And then if you look at something like Microsoft, what's the PE ratio on Microsoft? 29.25. And to round this exercise out, we look at something like Apple, where the PE ratio is 25.66. So of that bucket of stocks, which are kind of like the FANG type larger tech stocks, Google has the best valuation right there. And when the market starts pulling back, valuation matters more and more and more. And what's our fear with this trade? Our fear with the trade is that the market continues to come back down, right? And if the market continues to come back down, we've got a stock that we're comfortable with from a valuation perspective at 92.8. And you'll have to remember too, as the price decreases, that PE ratio decreases even further, right? So if Google drops another 10% and gets down to like the mid 80s, that PE ratio drops to like 17 or 18. And then that investment gets even more attractive and we could scale further and further and so forth. So in theory, as long as Google doesn't go to zero, which I don't know, a meteor could hit the earth tomorrow, we're going to be fine. We just keep chasing this thing down. Now, what we do want to be cognizant of is if we put all this work week after week after week to play the stock further and further and further down from our break-even price, we want to be able to reap the rewards of, if it starts selling off like it did back in November, what happens when it pops back from 83 to 99, like a $16 jump? We don't want to just make $1 or $2 at a time. So as it gets further and further down, what I would propose to defend against that a little bit is keeping these a little further in the money, right? So you'll notice as we go further and further in the money, the premium on these puts gets higher and higher. So if you wanted to play like a $5 rebound, you could have sold a 100 strike put for like $5.55-ish, meaning if it rebounded that much, you get $500, as opposed to like the 248 that we're trying to get back this next week. But again, that's maybe a little bit further down the road. As it currently sits, Google is going to be profitable where it stands. So there's really nothing that I feel like we need to do in terms of managing this position any further, just knowing that we're comfortable adding another contract. And speaking of adding another contract, let's talk about CPI, which is going to be happening on Tuesday morning. CPI is obviously one of the more volatile events in the market because the market really only kind of cares about interest rates right now and how they affect the market. We go to a 180-day chart here. What you're going to see is this big spike and then drop off in December. What are we looking at right here, right? What caused a candle on the morning of December 13th from 400 to 413, and then 4 days later took it from 413 down to 380? That's a massive dip. So what is that? The answer is CPI came out that morning. There's been a lot of speculation that we might see another hot CPI number. The way that the market is pricing things in currently, if you type in FOMC odds, you can do this very same thing on your computer. Go to the FedWatch tool and you're going to see the probabilities, come on, for rate hikes, right? So the target rate currently, or the current rate is 450 to 475. The way that the probabilities stack up is that the next time the Fed raises rates, which is going to be on March 22nd, there's a 90.8% chance that they only raise them 25 basis points. Now, if we see another hot reading on CPI and inflation's picking back up a little bit, you're going to start to see this number creep up a little bit. And how does this get priced into the market? It gets priced in the market through something like this, where it falls back down pretty sharply. So we definitely want to be cognizant that CPI, which is probably the biggest driver of the Fed's decision making from a rate perspective, is going to be coming up and is going to be very, very volatile on Tuesday morning. So because of that, and let's just get into next week here, we propose that we hold a very small number of positions. We've got a lot of cash in our back pocket right now, about as much buying power as we've had in a decent amount of time. And I think we just wait, right? We know that 5 days in the market is a very long time. 4 days is similarly long. So if something is happening Tuesday morning that we think is going to be incredibly volatile, why don't we just wait until that happens and then react to it on Tuesday? I really don't want to get in the business this year of guessing for these binary events, because I feel like so often in the past we've gotten burned by them. So let's sit back, right? We've made steady profit and we're in line for steady profit if nothing really happens again. But let's sit back. If the market tanks, that's fine. We'll add another Google contract. We'll potentially add some more EA. And then there's probably going to be several opportunities to add more and more bullish positions and scale into those as the market dips. And if the market does dip hard like that, that almost certainly assures outperformance, right? Because if the market goes down like 3% next week, sure, this might go to like 5. Google might be worth like 6 if it drops down. These bearish positions are going to make max profit, but EA might go to like 4. Lyft could be worth $1, and this is like, maybe an extreme drop for what I'm pricing in for some of these. But that's a loss of less than 1%. And that's if the market dips like multiple percent. So our positions are sized small enough as it currently sits, where I think we're going to be able to weather that storm pretty effectively. And that's ignoring the potential for us to scale in and add more bullish trades on top of that, because eventually, things bottom out somewhere, it bounces somewhere. We trade on a short-term enough perspective on like a Monday to Friday basis where we can catch those short-term trends. But this is kind of the game plan for next week. And apologies for not having some super in-depth like strategy talk for next week, but really I think the best idea we have here is to sit back, wait for Tuesday, and we don't want to have nothing, right? If CPI were on like a Thursday or something, I probably would want to have nothing going into that and play the market on like a Monday to Wednesday basis. But as it currently sits, Tuesday morning is plenty early in the week for there to be lots of premium. We've seen volatility ticking back up, and one thing, a super prominent trader, Carl Icahn, placed a $50 million bet on ES puts. What does that mean? He thinks the S&P 500 is going to take a turn for the worse in the coming week. And one thing that I do want to mention that I don't have on here is I also, in case that huge market meltdown happens, I want to have a position that benefits and doesn't really have a capped profit, right? So much of what we do is defined risk, defined gain. So one of the things I was thinking about is potentially looking at SPX. And we would previously play these credit spreads, but what if we turn one of them into like a debit spread and took the other side of the trade, right? We normally open put credit spreads when we think the market is going to go up. So what about opening a put debit spread if we think the market is going to go down? And typically we open these for like $1, and you could find $1 down here at like 4.0, not quite. Maybe 4,000-ish is where you could find about $1. That looks about right. So instead of selling these, if we bought like 5 of them, yes, it would be an investment where we lose like, $600 if the market goes down. But the upside of this, if the market dips and goes down pretty hard below the 4,000 level, is that you're taking home a profit of $2,000 here. And you may say 600 is pretty large. We could literally cut this down to 2 contracts and do something where we only sink like $240 into it. And if this will load, come on. And we sink like $240 into it to make $760. I think that potentially is a decent hedge in the market. But the other thing that I've actually placed right now is what if we just bought a put on an individual stock? And we know that we sell puts on a weekly basis because that's when, option premium decays the quickest. We think those are the dumbest puts for people to buy. That's kind of proven itself out with how we've been performing. So if we want to buy a put, how would we want to do it? And the answer to me is going like 124 days out here. And I did it on a stock that's very, very overbought. Maybe not so much on a 180-day basis. It's come back a little bit on a 1-year basis, but on like a 3-year basis, it's still somewhat elevated. This stock is still pretty steeply overvalued. The CEO sold off a lot of the stock recently. And we've seen it run from 350 to 500, and it's pulling back now. And if it gets below this 450 level, which, a move from CPI definitely could take it below that, I think we're going to see some really, really nice progression with the value of this. So what I did was I bought a 400 strike put, and I bought it for June 16th, 2023 expiry. That's 124 days away. The idea here is that if the market absolutely gets crushed, right, and some of the cash secured puts we sold and some of the stock, like with FTCH that we hold, starts getting crushed, the idea is our losses and gains, or our gains rather, on this one really aren't limited. I mean, in a literal sense, if it goes to zero, yes, that's the limit of how much money we can make, but that's not going to happen. The idea is if things really start tanking here, this takes like a 10% drop next week and gets back down near this 400 level, what are at the money options trading right now at? They're trading at 41 bucks a share. So if this makes it down to 400 in the near term, these become at the money. That could get up to like 40-ish bucks for the option. And that would represent a gain of $2,000. And on the flip side, if this starts to run against us a little bit, runs up like 20, 30, 40-ish bucks, we maybe lose 400 or 500-ish. And this is a position where I'm going to say, hey, if that does happen, we're just going to accept that loss and move on. But I think it's a decent risk to upside situation here. One where the stock's been heating up a little bit to the point where if the market does rip up, it might not rip up as much with the market, but also to the point where if the market crashes, potentially it accelerates the drop on that stock and we're able to benefit a bit from an increase in the premium there. But again, a lot of this is dependent upon CPI. I really don't want to hold too much. When we know is a continuation, Spotify is a continuation of a trade we had last week. But aside from that, we don't really want to load the boat here. Only other position I think worth talking about is the lift that we have, and I think that kind of rounds out everything we hold for next week. It's a 10 strike put, and we started this last week, and this is a trade I like to get in sometimes when there's a really, really steep drop on a stock and it's Friday. Friday being the operative term here. So we see a huge drop. We know that there's pre-established support at around this 1020-ish level, and what do you know? The red candles continue down to 1020-ish, which is why we love looking back at the chart. But again, RSI is in the gutter right now. It's down at 30.003, not quite blue, so it could get worse. But the idea here is in such a short time frame, especially looking at just Friday, it opened at like 11-ish, and we had the opportunity to sell 10.5 strike puts for 22 cents. And a 10.5 strike put for 22 cents a premium sticks you with a 10.28 break-even price, which got us, let's zoom in a little bit, it got us right around here. And when the stock is trading up, let's get the line down, there we go. When the stock's trading up here, and you can get a break-even price that's down here, and you look and zoom out on the chart and you see that there's pre-established, if we extend this to the left, there's already support kind of in that level. To me, that's a no-brainer. Yes, the stock has dropped a good bit because earnings weren't great, but look, when something goes from 18 to 10, at some point, look, the company's not announcing bankruptcy or anything. You could kind of play the shorter term trade here. And why I love doing it on Thursdays and Fridays so much is, as you'll see when we go back to the 5-day and zoom in, yeah, it did move down against us and get down to 1027, 1031 was the close price. But what can we do? When volatility is still this high from the stock dropping this much, this quickly, volatility comes back down eventually after earnings, right? It comes back down eventually after earnings. When you get a huge dip after earnings, look, it hasn't come back down yet. And volatility dropping after earnings is a pretty steady trend, and we haven't seen that happen yet. And what happens when volatility drops? Premium comes out of those options. So what's great is that not only on the front end were we able to get a very, very nice break-even price, which you could see demonstrated again by zooming in right here. That's a nice one-day break-even price, but what's also great about this is you could turn and flip the trade the next week because implied volatility is still pretty high. And what we were able to do, the typical management of our trade, right? We want to roll down, we want to roll out, and we want to do it for a credit. So we roll from 10.5 to 10, and we close for 0.2, and we open for 0.36. So if we run through our break-even price here really quickly on the calculator, we started with the 10.5 strike. We sold it for 22 cents. Our initial break-even price was 10.28. We rolled for a 16-cent credit, meaning we sold for a 36-cent credit after closing for a 20-cent debit. So that's a direct reduction of 16 cents to our break-even price, taking us down to 10.12. So yeah, 10.12 is below where the stock currently is, but that's also not the end of it, right? We know that since we rolled from a 10.5 strike to a 10 strike, that's an additional 50% or 50 cent. I wish it was 50%. An additional 50 cent reduction to our break-even price right here. It's taking us at 962. 962. So if we thought 1028 was good on a 5-day basis, we're now down here at 962. And again, we can double down into this position. This is still a half-size position. We don't need to add anything yet. But again, if Lyft does find a bottom here at 10 and rips back up a little bit, as we've seen with some other earnings, Snapchat's a great example of this, where if you go to the 20-day, they had earnings recently. Huge red candle, right? What happens? 2 days later, they were back up the top. Now, Lyft was such a significant drop that I don't expect it, obviously, to get back up here. But even a return to 11 would look really, really nice for these 10-strike puts that we sold. And that's a potential $360 of profit there, which you'd add on to the 20 we got last week for $380 total profit. After entering with something at 11, it being at 1027, and just as long as it doesn't drop 27 cents more, we're still going to make more than our original max profit on the trade, which is only 220. So that's a really nice benefit of taking advantage of some of those Thursday or Friday huge drop-offs, being able to identify support on the chart, identify elevated implied volatility, which gives you that opportunity to roll down and out for a credit at a very advantageous strike and premium. So that's an opportunity we look for. We're kind of in the back end of earnings season, so we're probably not going to see too many of those anymore. But just an example of what we try to play out there and what this Lyft position really is, right? It's a continuation of this from a prior week. And the great part about these IV-driven trades is something like CPI. Yes, it'll probably knock it down a bit if the market goes down, but they tend to act a little bit more independently of the market. So some of these more IV-driven trades, in essence, are almost hedges against the market because they act a little bit independently. But that's what we got, right? Big thing for next week. CPI is coming out Tuesday morning. That figure is going to shoot the market up or tank it. I really don't think there's going to be much of an in-between. But if there is an in-between, guess what? We're probably going to be looking at a pretty good profit because the premium's just going to melt off of these. And then we can move forward, scale back into more trades on Wednesday or Thursday or even Tuesday afternoon. But another important point to make is we want to give it a little bit of time to breathe, right? We saw that when we looked at S&P 500. I don't want the reaction here to be, oh, let's zoom in on this really quickly. Remember this December spike, right? We saw it go from 400 to 414. I don't want the reaction here to be, oh, the market's up. Let's just start scaling into positions, bullish positions now because the event is behind us. Yes, the event is a quick event in the morning, but the impacts of the event are continued, typically for multiple days. So we don't want to get too crazy on Tuesday morning. I think Tuesday afternoon, after we get a little bit more clarity in that regard, is going to be a much better entry point. So look for us to enter into those positions at that point. But that's about all we got. Let me go back to the full screen webcam over here. There we go. And let's wrap it up. Thank you guys for those of you who got up a little earlier today to tune in with us on the special Sunday noon earlier edition of our stock market scan. Some interesting ideas for next week that we've got in play, but overarching idea, CPI is going to be very dangerous. I probably sound like a broken record, but can't repeat that enough. Just one of those super binary events in the market where, it's probably not going to make our year or make our month if we are on the right side of it and have our best place there, but it's something that definitely could take us in the other direction significantly so, if it moves against us. So general idea here is we don't want to take these big dips down in our account. Look, if we trade flat where, if we had been in, it would have gone up a bunch, whatever, right? We're never going to get mad at like staying flat or making a little bit of money if the flip side is the potential for us being in on a volatile event and the market, moving down very, very sharply. But overall in the year, we're plus 5.28%. And this is where I can't emphasize enough the value of just running our own race in the market. Yes, the S&P 500 are up big, or the S&P 500 and NASDAQ, that is, are up big this year. But look, like we talked about at the top of the stream, those are historic jumps in the market. We don't want to base our performance relative to those on those historic jumps. We don't want to trade as if those historic jumps are normal, because they're not. That's why they're historic jumps. So we run our own race. If the market's getting overbought or we see stocks that are getting overbought, yeah, we'll step in front of those a little bit and play them back down with some bearish trades. But generally, we like to be a little bit more bullish. I like the idea of balancing an overall bullish portfolio with some bearish trades to get some neutrality in that sense. But when the market's up as hot as it has been, and it's cooled off slightly, we'll see what happens on Tuesday. But when the market's as high as it has been, we don't want to have that same quantity of bullish trades. So hopefully CPI pulls us back a little bit and then we're able to scale back into the portfolio that we're a little bit more comfortable with on a week-to-week basis with some of those bearish or bullish trades. But again, that's all we got. Thanks for tuning in. This has been the Hourglass Trader, where as time passes, we make money, or at least we try to, but Thank you guys. Out of town next week, so we're not going to be having a stream next Sunday, unfortunately. And I'm sure it would have been a great stream where we celebrate tons of profit, hopefully. But 2 more weeks until we are going to be back online. But as always, hourglass-trader.com, big purple button on the homepage is going to be the link to join our Discord server. And we are always going to be active on a day-to-day basis in there, chatting through strategy, announcing our trades, and just talking generally about what we and the market are doing. So until next time, thanks again to all of you who consistently tune in. One of these days, we are going to get 30 viewers live and give away one of these HT tumblers. We've got a few of them to give away, but one of these days is going to happen. We're getting like 15-ish, and maybe streaming a little earlier knock those numbers down a bit, but we're coming back strong in a couple of weeks. We're going to get there, and one of you is going to have this. Please, I don't want to hold on to this anymore. But again, thanks so much to you who tune in every single week, and we will talk again later. Jules throwing a Go Chiefs in the chat. I mean, I guess if you want the Chiefs to win, I could root for the Chiefs to win. But hope everyone enjoys the rest of their weekend, and we will talk again. I don't know. I'm talking in circles. See you guys later.